because you could be earning less inside of the plan than what the loan interest rate costs you, and then lose in the stock market.
I know.
Dude,
Think about it. Okay, let me put that into more layman's terms. You borrow against your policy. Let's say you pay 5% to borrow against your policy, this $1,500. You take that $1,500, you put it into the stock market. The stock market, you invest $1,500. Let's say the stock market goes down 10%.
When does your butt pucker when the market goes down?
You lost 10% of the $1,500, and on top of that, you lost the cost of borrowing at 5%.
Simultaneous loss.
You've literally increased your loss by 50%.
I am on Dave and Susie's side. If this is what if it's this or Dave and Susie, I'm going to Dave and Susie, bro.
I agree.
Who thought that I could go there? One of your favorite things to do, expose me to new stuff and have real reaction to it. So
it's fun.
Have no idea what we're in for here.
This is, so just to give you a heads up, like a little precursor here. So this is a leader for FFL, Family First Life.
They're big. You just told me about them.
They're big.
I've heard about them a couple times.
Almost 30,000 agents, and they're now going from the final expense markets into the index universal life market, which you know how I feel about that. We share that sentiment. Right. And so this guy is a lead trainer for an organization inside the FFL group.
Okay.
Want to know how the wealthy get wealthier, and this is exactly how they do it. During every depression, during every recession, the only companies that ever lasted through absolutely everything are the insurance companies, and here's why.
Is that true? The only companies that ever lasted?
The only companies? No. I mean, they're certainly the most stable, but IUL didn't exist at that point in time. You know, like they're and that has nothing to do with what's in it for you. Like I'll tell you right now, I got news for you. You could put your money in an IUL. The insurance company might make it through. It doesn't mean you're making it through with your policy.
Yeah, just wondering on that.
Yeah. I need an intro like this.
I don't know, man. Have you ever watched any sitcom and Happy had an intro?
I guess not.
I never have.
All right. Good call. You taught me out of it.
There you go. It's not a good hack.
So we're going to be doing a training today on becoming your own bank, right? What this essentially means is using life insurance while you're living.
I'm upset with myself for using the term banking as much as I have in the past.
You know, I kind of am starting to regret it myself.
All right, just saying.
Not just using it for when you're dead, okay? Now, we'll open it up for questions at the end. When I
don't mind banking alternative.
Yeah, banking alternative. That's,
yeah.
Go over everything, and that way we can jump into a little bit more detail. But however, it's the term BYOB. A lot of you know it as bring your own beer, but I'm going to teach you what it really means, becoming your own bank. Okay, so I'm going to give you first an example of what we call an indexed universal life policy. It is a life insurance policy. It's kind of like a whole life policy and a term life policy came together.
Okay, kind of.
A term life policy and a whole life policy came together and had a baby.
It's more
Is that
like
what he was about to say?
Yeah, that's what he's about to say.
Okay.
And I'm like, okay, maybe it's more like a term life policy that's a little bit more expensive that you overfund.
Yeah.
But it is a little bit like a whole life and a term life had a baby. I'll give it to him. Yeah.
Had a baby and presented you an indexed universal life. Okay, so this is a real life.
But like the first baby was universal life because interest rates were really high in the 70s and 80s. And then it was like, no, the market's killing it in the 90s, so let's make it variable. Then it was like, I don't know what the market's doing. Let's just go with a hybrid between the two.
It's kind of like twins and Danny DeVito, you know?
And this is Danny. This is the Danny DeVito.
Yeah, exactly.
Life example to kind of give you a really good idea on how it works and what it costs and what it covers. So let's say a 30-year-old male is paying $100 a month for a $200,000 death benefit. Okay, so it is life insurance. This is the death benefit here. Here's how.
Okay, so first they are speaking to the masses here.
$100 a month. I got news for you. If you're only funding any IUL at $100 a month, the admin fees and all the costs that are fixed inside of it are.
Did I tell you that when I was 18 years old, I bought a World Financial Group? $70 a month VUL.
You did tell me that.
3 months later, I was like, this isn't going to work because I was in an econometrics class and I was like, duped.
Yep.
How much this IUL costs for a 30-year-old male, $100 a month. Okay, so over the course of years, this policy, by making that minimum payment, will accrue cash value. The longer you make these minimum monthly.
I can already see things on the board that are
raising hair.
More cash value you then accrue. Here you have 5 years, 10 years, 15, 20 years, and this is a pretty good estimation, 5,000, 10,000, 15, 20,000. After year 20 of a $100 payment, you have about $20,000 in cash value accrued into this policy, okay? Now, let's just give you an example on year 2. Let's say you have $1,500 cash value built up in your policy.
Okay, I doubt that's going to happen if you're doing $100 for a $200,000 policy, because that isn't overfunded enough to get to $1,500. If you're overfunding, you could easily have more than $1,500.
Yeah,
but you'd probably have a lot less death benefit.
Not on $100 a month though. Like you're talking at the end of year 2, $2,400 in premium total, and not to mention that's cash value after surrender charges and stuff. You're lucky if you have any access to any money.
You can then go and take a loan out of that $1,500, meaning you can borrow against your own policy. And then what you can do with that $1,500 is then invest it into the stock market, right?
It's so hard to listen to that, dude.
I'm just gonna
okay. First off, you could just skip the IUL and go straight to the stock market when you invest in the stock market. Why would you pay insurance fees on a term chassis when you could just buy term?
Because you're a kamikaze.
And then go put it in the stock market without any caps and not any. But like,
because the stock market doesn't have enough risk.
Why would you use IUL?
Why not just inject more risk into a risky thing?
Why would you have something that caps your return to then pull a portion of that out because of the fees and then put it in the stock market? Dude, I can't even fathom that ever happening. Buy term, invest the difference will be far superior to what we're talking about right now. I promise you that.
And I can
run the numbers. But term and invest straight to the stock market. Term's going to be cheaper. You could get a cheaper term policy than you're going to pay for the insurance inside of the IUL. You're going to have more cash in the mutual fund without any upside limitations. I get it. Like maybe this works from 2000 to 2002. Maybe this works from 2008 to 2010. Maybe this works from part of 2019 to the end of, somewhere in 2021. Maybe.
Sure. I know.
Right now, stock market's lower right now. It's a really good time to take advantage of a situation like this because you can put that $1,500
Bosworth. You should just be playing football. It's a Bosworth.
dollars into the stock market, and then you can simultaneously grow your money in both.
Okay.
Go ahead.
So simultaneously grow. Let's say that this is 30% of what you put in is gone to cost. So you have 70% left over. You're going to then take 70% of that out in a loan.
It's going to be more than that, but
to invest in the stock market, and then still have your money in there with a variable situation that you could actually lose because you could be earning less inside of the plan than what the loan interest rate costs you, and then lose in the stock market.
I know,
dude.
Think about it. Okay, let me put that into more layman's terms. You borrow against your policy. Let's say you pay 5% to borrow against your policy, this $1,500. You take that $1,500, you put it into the stock market. The stock market, you invest $1,500. Let's say the stock market goes down 10%.
When does your butt pucker when the market goes down?
You lost 10% of the $1,500, and on top of that, you lost the cost of borrowing at 5%.
Simultaneous loss.
You've increased you've literally increased your loss by 50%.
I am on Dave and Susie's side. If this is what if it's this or Dave and Susie, I'm going to Dave and Susie, bro.
I agree.
Who thought that I could go there?
Of these situations, not only in the stock market, but that $1,500 along with your minimum payment is still accruing cash value. With
the minimum payment is not accruing cash value because the minimum payment has cost of insurance against it that is substantial on the minimum payment, the way it's being funded.
If you pay the minimum payment on an IUL, you're not going to have any cash value for 3 to 4 years.
Your policy, because you didn't withdraw this money, you took it out as a loan, you borrowed against it, okay? Now, there's not a time frame to pay this back. So you can take this $1,500, put it in the stock.
You know when there is a time frame to pay this back?
When the company sends you a lapse notice.
No, I mean, you and I are on the same page. Like, bro, why are you making my blood pressure this high?
It's so much fun. I need somebody else in the world to experience what I experience and feel how I feel. I'm glad I got you on my side, bro.
This is why I do a lot of writing.
I know.
It's like therapeutic.
For some years, while it's low right now, until it goes back to a higher percentage. Okay. Now, once that higher percentage, you've made your profits. You can.
again, just the assumption it's going to be a higher percentage.
Hey, didn't you know the market just goes up every year though?
Then take your profits, take everything, put it back into this indexed universal life policy to then gain more value. Now, the best part about all of this, being able to simultaneously grow your money, is you can never lose here.
You can't? I think we just talked about it. So you just borrowed it. I'll do this for Garrett here because he's going to kill himself here.
Dude.
So
You can
never lose there. Yes, you can, because what's happening is you're borrowing against it. You got loan costs. Now, when you lose money on the investment that you made,
insurance goes up.
The cost of insurance, you got to pay for the cost of insurance on a negative year. Plus, you have loan costs of 5%. So if you lose 10%, now you have a 5% extra fee on top of it. You've increased your loss by 50%. Now the cost will compound against you in the IUL. This is,
bro. I'm sad. I'm sad. Like, I don't understand.
This is what we're
so
up
much
against,
work
bro.
to do, bro. Like, it's.
I know.
Why did I hang out with you, dude?
Are you
now I have to rewrite.
Are you crying?
I had to rewrite What Would the Rockefellers Do?
Okay.
Yeah, that reminds me. I get these injections for my kidneys called neural injections, and my son, when he was younger, is in there, and I'm getting them. It's like the doctor's like, these are gonna feel like bee stings, and so like there's tears rolling down my eyes, and my son's like, Dad, are you crying?
Yep.
And that's dude. I'm kind of like joking a little bit, but like this is really destructive when someone can barely afford $100.
Mm-hmm.
Pay off your credit cards.
Mm-hmm.
Invest in a skill set.
Mm-hmm. Get term insurance and go do the other stuff.
Dude.
Yep.
You always either gain or stay the same. Gain or...
That's not true, because when you stay the same, there's still a cost to the insurance that you're paying the $100, which is barely covering that.
And the loan costs.
Stay the same. You can never lose money. To have an optimal portfolio, you need to have an indexed universal life in your portfolio as a safe cash investment vehicle. Okay? And the coolest part about all of this is, let's say you do die, your family gets...
That's the coolest,
part is you die.
The coolest part.
Coolest, like, dude, I've got this great feature that if you die, it'll work.
Yeah.
But if you don't die, it will lapse.
You're screwed.
The coolest part is when you die.
It's a big lump sum of money, $200,000.
Could go so bad you might just kill yourself.
Now, what
Just wait
questions
for
do you
the
guys
2
have
years
on
then.
this?
How long does a policy last for?
100 until 110 years old. Chances are, if you live into 110, is probably very slim. So this policy is pretty much your entire life. Any other questions?
Yeah, I got one. Is it better right now, given the stock market being down, to keep the money, you would say, within the policy, or do you suggest right now taking that out? Because I'm not sure which would be better for an individual at this point in their life. Can you tell me about that? As a 30-year-old male, does it depend on how old they are?
Not really. Actually, it does depend on how old they are and what their pre-existing conditions and their medications are, because not everybody can get approved for one of these policies. They're actually one of the hardest policies to get approved for.
Not true. Disability insurance, way harder, dude.
Yeah, and all insurance, it's the approval is the approval.
If you're a 30-year-old male, chances are you're relatively healthy. Sometimes you don't even need blood work or anything to get approved for this. You can get approved within 10 to 15 minutes.
By paying more.
This is what I'm talking about. Like, this is, so we were telling, actually, I didn't do it on video. I watched one of their full rollout live trainings. I was on the live webinar for an hour and a half, bro. It was torturous for me to not like chat in the Zoom comments, right? And they said, this is the best product in the world because it gives the best compensation. You can sell in one close and you have a chance to win a sports car.
That's why it's the best.
That's why it's the best.
Me, you.
Yep, pretty much.
By speaking to the right consultant. Now, if you look at this as a whole, I would say it all depends on your financial situation, right? If you have, money in the bank, money in stocks, and you have, an extra $100 sitting aside a month that you don't mind spending, I would absolutely put it into an index universal life.
That you don't mind spending.
Yeah. If you don't, you just light it
spend
on
it.
Fire.
Just
I say go
spend
to
it and
Vegas. Go to
enjoy it.
Vegas. Don't do this. Go have some
Policy,
fun.
as it's a safe investment vehicle, and you can simultaneously grow your money.
It is not an investment vehicle. It is an insurance policy.
Yep.
It is not safe when it's minimally funded.
It's like one of the least safe things.
Once it builds cash value, so you can double dip. I don't think there.
Here's where the real double dip is. minimum fund it, and then pull the money out and invest it somewhere else. The cost of insurance eats away at this, and when the market doesn't perform and that goes down, you still owe money on the loan.
It's not double growth, it's double loss is the real risk.
There's a reason not to have one of these policies. As you get older and it's building this cash value, you set it and forget it. First of all, you're protecting your family with a $200,000 death benefit. Second of all,
which is the coolest thing when you die.
Say you never touch this money and you don't do the simultaneously growth and you just let it grow itself. Well, by year 20, your kids are about to go to college. You have $20,000 in cash accumulated. You could
awesome $20,000. You can't pay for a semester.
No, first of all, you won't have $20,000 in cash at that point in time with this
because this is $1,200.
Never.
$1,200.
You paid 24 grand in, like.
Right.
It's never gonna.
What about the cost of insurance on that?
Yeah, I mean,
pay for your kids' college, and when they're out of college, you can put the money right back and let it keep growing.
Is there any advantage, it might sound like a crazy question, having more than one life insurance policy?
It all depends, yes, sir. Because different companies have different vehicles that they use in order to obtain these percentages. One company might be able to grow this between 2.5% and 4.5%. Another company might perform at 7 to 8%.
Then why wouldn't you just go to the 7 to 8% company?
Yeah, what company is doing 7 to 8%? Right, like. No.
Compounding interest. That's when it comes to doing your own research, looking at the reviews, reading into different
the compensation
companies, how they invest your funds. So there's a number of different things that can make those different. I can't be the end all says all, but I can give you my professional opinion on some top companies that do really well for these index universal life policies. What else, guys?
Does the premium remain the same? Or
this premium never changes. Never changes. As long as you make the minimum payment, it will never change.
That's actually not true.
No, like that
is not true.
No, I mean
if it's minimum payment,
if it's minimum funded,
and the guaranteed costs go up. There's that certain. It depends on the company. Even if there is that cliff where you might have to pay more at a future age.
Even if it's not even minimum funded, even if you target fund this, there's a chance that it's high likelihood, over a 50% chance, I'll say, that you will have to come out of pocket for a fair amount of money to keep the policy from lapsing.
Are you able to withdraw the money?
Withdraw the money? Absolutely, but then you surrender the account. And if you withdraw the money at a certain time frame, you lose some of the cash accumulated value. So it is advantageous
surrender charges
to keep this policy going as many years as possible, because in certain policies, now all policies differentiate, but depending on the year that.
Just the language, dude. I have a hard time.
I know it's pretty obvious he doesn't really fully know.
Yeah.
Like
you decide to surrender and withdraw, you will lose some of that cash value built and get a lower amount if you withdraw. So definitely.
He's talking about surrender charges. How does the surrender charge impact a loan?
How does the surrender charge impact a loan? Well, you can't take a loan against surrender charge.
Right. So it doesn't matter whether you loan or withdraw.
Exactly.
It's just that if you withdraw the whole thing, you lose the policy.
Well, you can only withdraw.
And a withdrawal actually changes your net amount at risk.
Yeah. I mean,
which charges you different cost of insurance.
Don't jump into one of these if you're planning on withdrawing it in a few years. That's not what you want to do in this situation. This is for longevity. This is for retirement. This is for building a legacy over time. And this is for leveraging life insurance while you're living and becoming your own bank, which is how the wealthy get wealthier.
Oh, yeah.
Here's the deal. The wealthy, I have to rewrite what the Rockefellers do. It's so annoying. But I actually love writing. It's just imperative.
You need a chapter.
I have to talk about the dangers. I have to talk about the misuses. I have to do all that context with this.
You could do like the same thing. Just add a couple chapters, like
So it's a banking alternative. I've used the word cash flow banking in the past. I've used the word banking, because of infinite banking early on, and it's like banking's not what we want anyway. The way the wealthy get wealthy is they create massive value. The way they store that wealth is not an IUL policy.
Wait, no, but all these guys are telling me the wealthy, that's what they do.
They get wealthy by $100 a month.
The wealthiest people are using IULs. They'll tell you that.
And is that the difference between this and like a term life policy?
Bro, I feel like that they probably read what the Rockefellers do and took some of the, that's why I'm so bothered right now.
I know. See what you did?
I'm locked in like 10, 20 years. This thing is lasting for a lifetime.
110 years old. This is definitely the better policy if you can get approved. Term life insurance is essentially renting a life insurance.
And Index Universal Life is renting the cost of insurance and overfunding it.
Like renting a house.
Yeah.
You know, I'm sorry?
It's pretty much like if you die,
Exactly. You're renting
kind of
insurance
like
for 30
leasing with
years.
the
After
option
30
to
years,
buy,
if you
but
don't
it's
die,
going to be
you're
really
just
expensive
SOL.
if you decide to buy long
we
term.
can transition you into a 30-year term policy that has a return of premium that gives you all your money back if you end up outliving the term. That would be my second favorite policy that I would recommend. However, Indexed Universal Life is at the top of my list as I'm a business savvy individual. I want my money to work for me, and I want to know how the wealthy get wealthier. And this is exactly how they do it.
Bro. The subtitle of what would the Rockefellers do is how the wealthy get and stay that way and how you can too.
Yeah.
And like the Rockefellers didn't get wealthy because they bought life insurance.
Especially IUL.
They got wealthy because they made petroleum extraordinarily affordable for everyone.
Yep.
And then other stuff. But
Life
they
insurance.
And then they used life insurance as a way to replenish wealth over time and protect it.
Right.
Not with risky types of insurance.
Right.
So
that's a very complicated conversation to have. This is a simple way to like put it on a whiteboard and
Be Your Own Rockefellers, my next book.
During every recession, the only companies that ever
The infinite Rockefeller concept.
there you go.
lasted through absolutely everything are the insurance companies, and here's why. They absolutely do. So not only does it have this $200,000 death benefit, it comes with cancer, heart attack, stroke coverage, essentially critical, terminal, and chronic illness coverage. So let's say, God forbid, you suffer
Here's the coolest thing: if you get cancer,
The coolest thing is if you get
years old, you
cancer,
suffer
a stroke, or
you're
you
not
die.
able to work, you're on life support, you're in the hospital. Some of these policies will pay out 25, 50, up to 75% of the face value while you're dealing with that family tragedy. What else, guys? Anything else? Awesome.
dude.
Awesome.
Yeah,
How you feeling?
I need a break.
Well, we got 15 minutes, so we got to go do this awesome training. So it's going to be fun. Guys, thanks so much. This is, now seriously though, the scariest part about all this, man, is that there's 30,000 agents
Learning
this. 30,000. How many whole life agents are in the country? I don't know. I don't even know if it's 30,000. And this is just one company doing this.
Well, thanks for exposing me to all this world.
You're welcome.
Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from, so go ahead and click through and watch the next video now.